Hi, my name is Khleif, and I'm the host of the Lifetime Cash Flow Through Real Estate Investing podcast. And every week I interview multifamily rock stars, and we talk about how they've built incredible wealth for themselves and their families through multifamily properties. So hit the like and subscribe buttons to get notified every Monday when a new episode comes out. Let's get to it. Welcome to another edition of How to Build Lifetime Cash Flow Through Real Estate Investing. I'm Khleif, and I am absolutely thrilled you're here. Now, I'm super excited about today's guest. And now I got the pleasure of meeting this gentleman at a mastermind that I attended and was so blown away by his presentation. I told my team we've got to get him on the show. His name is Michalowicz, and the reason I was so impressed with him is he's written numerous books. For example, Surge, The Pumpkin Plan, Clockwork, and his latest book is called Fix This Next. But the book that I'm most excited about, and in full disclosure, the only one I've read so far, is Profit First. In fact, I was so blown away when I saw his presentation that I had my whole finance team buy the book and start reading it. And so they're in the middle of it right now. So anyway, Mike's a really impressive guy. He's already founded and sold a couple of companies, one to private equity, one to a Fortune 500 company. He's on his third multi-million-dollar company. He's just a real hitter, and I'm super excited to have him on the show. Mike, welcome, my friend.
Rod, what an intro, man. I'm happy to be here. Thanks, brother.
Absolutely. So maybe you can kind of talk about how you discovered the concepts of, the kind of duh concepts as far as I'm concerned. That's the best word I can use to describe, what you talked about in Profit First. Maybe you can talk about how that manifested, and then I'd like to really get into some of the strategies, if you don't mind.
Perfect. Yeah, I'll lay out the manifestation, and there's four kind of distinct phases that I can share with you. So here's how I discovered it. So you were kind enough to share that I started and built some companies. They were both in the tech space. Both were multi-million-dollar exits. One was private equity. One was a Fortune 500. And one thing that I don't readily share on my resume is when I was operating those companies, they were not profitable. I was struggling. I was surviving check by check. I was lucky, honestly, to exit. And I ultimately discovered that's the hidden truth for most businesses. There was a SBA, the Small Business Administration, conducted, in part, facilitated a study and identified that a small business is a company that does $25 million in revenue or less. 83% of small businesses are in a check-to-check survival, which means 83% of businesses don't have enough cash flow today, not enough deposits coming in, not enough sales to support the expenses next week or next month, let alone the owner pay themselves. And so there's this constant, we got to bring in money mentality. But what confused me was how come so many businesses, I started my company for financial freedom. So many people started in part for financial freedom and joy. How come we can't figure out that financial freedom, the vast majority of us? And that's when I concluded that the foundational formula for profitability, which is sales minus expenses equals profit, is a flawed formula. It makes sense logically. You have to have sales. You subtract over whatever you spend, you subtract out, and what's left over is your profit. That makes logical sense. The problem is our behavioral use of that. It's human nature. When something comes last, Rod, it means it's insignificant. Like my family. I would never. I love my family. I'd never say I put my family last. And health is. If I had a health scare or concern, I wouldn't start saying, I better start putting my health last. What comes first is prioritized behaviorally. And what comes last is the perpetual manana syndrome. It can wait, it can get delayed. We've been told that profit comes last. And by the way, Rod, it's so pervasive that it's in our vernacular. We call profit the bottom line. We call it the year end. All these things mean last. And therefore we treat it that way. So I saw in execution, most business owners, myself too, would wait until the end of the year, do our tax returns, say, didn't happen this year, maybe next year, and the panic would ensue. So what the new formula is, and what I teach in Profit First, is every time we take a sale, we immediately subtract profit. So sales minus profit equals expenses. Every time we have a sale, every time there's inbound cash flow, we immediately take a predetermined percentage of that, hide it away as profit, and run the business off the remainder. It's the pay yourself first principle applied to business.
Love it. And guys, those of you listening that are, there are I know a lot of you already have your own businesses going. If you're still W-2 and you're getting into this multifamily space, you are going to put on your entrepreneur hat and start a business. That's why I wanted Mike on the show, because this strategy, I've built 24 businesses. Some of you have heard me talk about that. Several worth millions of dollars, tens of millions actually, and quite a few have been spectacular flaming seminars, I call them. But the point is, this strategy was so eye-opening for me. It's just, I'm disappointed that I didn't hear about it a lot sooner. So can you drill down a little bit about the mechanics of how you make it work? Because Mike, I know you did that when I saw you live, and I'd love to hear.
So let's go through the 4 phases. So I'll start off with phase 1. Phase 1 is the concept, I call it setting up small plates. And I derive this from diet, the study of a healthy diet. And basically what's happened in our diets is that plates over the last 300 years, plates used to be the size of like coffee saucers. That was actually a serving plate. Over 300 years, plates have doubled in size. With the doubling in size, our behavior has not changed. So 300 years ago, we would fill up the plate and clean it off. Well, today, with double the plate size, we still fill the plate and clean it off. But because the plate size doubled, the servings doubled, the caloric intakes doubled, and as a society, our waistlines doubled. So this instructor I was watching shared a real simple principle. Get smaller plates for your house. It automatically constrains and restricts your consumption. And I was like, oh my gosh, this physical fitness tip translates to fiscal fitness. And the translation is this. Most business owners do what's called bank balance accounting. Most small businesses the owners don't know how to read a cash flow statement, a balance sheet, and an income statement and tie them in together. They don't know the metrics. They don't set KPIs. And I'm not saying it's a bad thing. I'm just saying that's a typical thing. Instead of trying to force that down our gullet, and that's the mentality historically, it's like, well, you better learn your accounting, you better master it. We actually need to look at our existing behavior and then channel that existing behavior, not changing ourselves, but channel it to the outcome we want. What we do is we set up small plates. Most business owners do what I call bank balance accounting. We log into our bank account, see how much money we have. If there's money there, we can spend it. If there's no money there, panic ensues. So what we need to do is set multiple accounts at our bank. When I teach them profit first, there is what I call the 5 foundational accounts. One's called income, one's called profit, the next one's owner's comp, and there's tax, and then there's OPEX or operating expenses. And the idea is this. Money now, when you deposit money, you put it into this income account. Then we carve it up based upon predetermined percentages we allocate to the different accounts. So now we have a portion of that money reserved for profit. We were talking about that already. A portion reserved to pay ourselves a salary, which is different than profit. People confuse that. There's the money reserved for taxes. The biggest bill associated with operating a business historically for almost every business is the tax bill, yet people are least prepared for that. So the business is going to reserve that money for us on our behalf. The last account is OPEX, which is the true operating expenses of the business. How this works in practice is, say $1,000 came in the past. I used to think, most entrepreneurs used to think $1,000 comes in, hey, I have $1,000 run my business. That's not true. Now, when $1,000 comes into that income account, we then carve it up based upon these predetermined percentages. We realize, $100 is actually reserved for profit. $200 or $300 reserved to pay a salary for me as the most important employee, the owner operator. A portion of that is reserved for taxes, and then the remainder, say $300 or $400, is actually for the operating of the business. We don't have $1,000, we have $400.
So let me recap, if you don't mind, just because you did that really quick, and I think people's heads might be spinning. So what he's talking about, guys, is you actually open these individual bank accounts at your bank. One for income, one for profit, one for your ownership revenue, your salary or however you pay yourself, then one for your taxes as a reserve account, and then your operating expenses. So the income, correct me if I'm wrong, that income account really is pretty much just a pass-through, is it not? It takes the revenue in and then it pretty much empties out. Yes?
That's exactly it. So I call it a serving tray. And the analogy I use is Thanksgiving. When that turkey comes out of the oven, no one says to all the guests, hey, everyone grab a knife and fork. Everyone for themselves, fight for it. We carve the turkey. And the reason we carve the turkey is to apportion food to every guest at the table. It's that simple. So the income account is a serving tray. It's a cash turkey for the entire business and its owner. And we then need to carve it up.
Got it. And so what sorts of I remember there were several, in fact, a couple of the guys that run the mastermind that you spoke at had already started this process. Some do it with slightly less accounts. They might just do 3 or 4 of the accounts. Yeah. What sorts of scenarios have you seen and if someone wanted to start this, what might be a less stressful,
Okay. That's a great question. And
okay.
We have the data now to back it. So I'm very proud and humbled at the same time to say that over 300,000 companies now do this.
Wow.
And we have lots of case study feedback. And businesses sadly have failed at it, and many businesses have been successful. Here's the big differentiator. The successful businesses started slow and they let it grow. What I mean by that, instead of setting up these 5 accounts, and in fact, in the advanced discipline of profit first, you can set up 10 or even 15 accounts. In the most basic stage, we set up just 1 account, and it's a profit account. And the whole goal is this: keep running the business the way you've always run it. But when a deposit comes in, let's start with a very small percentage, maybe even just 1%. Allocate that 1% toward profit, and then when the next deposit comes in, do the same thing. Because the goal here is you're not going to get rich overnight. This is not a get rich quick. But what it does is it starts building the profit discipline. It starts teaching you to take your profit first. And when you see now this is a cash profit. This is not a accountant, you had a $50,000 profit they circle on your income statement, and you ask them where it is, and you're like, oh, you don't have it, you spent it. That's an accounting profit. This is a cash profit. And once you see that 1% accumulating, then we start getting encouraged and saying, what if I try 2 or 3? And it starts building, and we start adjusting our business to support that profit. So start with just 1 account. That's what I suggest. Okay. And then as, what sorts of hurdles do you see besides, jumping into this and being overwhelming your team and yourself likely? What other sorts of hurdles do you see? Any mental blocks or things that people need to push through when they start this? Yes. So the biggest thing is going too fast, right? So it's like hitting a gym and you haven't worked out in years, and you say, I'm going to throw up 300 pounds on a bench press, and you tear out your shoulders. So start slow. Here's the second thing, though, is that when you start taking your profit first, there's less money, obviously, for the operations of the business. Some people will not be able to pay their bills, of course. Now, here's the lesson. If you can't pay your bills, that means you can't afford your bills. Many people, sadly, they can't pay their bills and they say, oh, I can't be profitable. That's not true. This is your business speaking to you. Because if you take your profit first and you can't pay your bills, that's your business saying you want to achieve a 5 or 10% profit, whatever you're reserving. You can't do it under the current circumstances. You're paying too much. And there's only 2 ways to adjust it. One is to cut costs. In our studies, we found that almost any business can cut 10% of costs pretty much overnight. There's negligible costs everywhere. Cutting more than 10% starts getting a little more difficult, but maybe businesses can cut up to 20% cost. So that's one quick, easy opportunity to increase profitability. But the bigger, more important opportunity is margin. How do we get more value out of what we're selling? How do we dictate a higher price point and a lower cost associated with the acquisition of the raw materials or whatever for that product? So when you can't pay your bills, you have to cut costs and you have to increase margin. And I think that's a challenge to people. They can't pay their bills with the system and they give up. And that's a shame because they go back to the way that wasn't working before. Well, you say increase margin, but really beyond increasing revenue, that's the only way to increase that margin. Well, I don't know the real estate market too well, but you got to be really coy on buying low-valued properties. When I say low-valued properties that are undervalued, that you can increase the value. Okay. So the margin is the acquisition cost and the selling cost, and how do you increase that gap? Okay, or the cash flow that you generate passively from that asset because you bought passive income. Right. Exactly. Right. Okay. That sounds good. Now, so if I were to give someone a step-by-step, and I'm going to tell you, go get the book, guys, for sure. But on a step-by-step, they open that first bank account. They put maybe 1-2% in just to see how it feels and get that mindset going. Any other thoughts or strategies that we might be able to share with my listeners that they could plan to encounter? And then after they get that mindset around that first account, what might be the progression and how could they continue that implementation? Yeah, so that moves us kind of to the second phase. So the first phase is saying, that was phase 1. Got it. Yeah, that was phase 1. So phase 2 is exactly what you're asking about. Phase 2 is that the owner of the business, at least initially, should actually manage the transfer of money. It's very easy to outsource and say, I'll have a bookkeeper or something do this. the thing is, there is a visceral behavioral response when you allocate money toward profit in these other accounts. It feels good. It actually results in a dopamine response. It's called a reward mechanism. So when you transfer that 1% into profit and you see, even if it's a few $100s, it's like, hey, there's cash piling up for me. As you said, these other accounts, they are in sequence for a certain reason. The income account comes first because it's a serving tray, to your earlier point. Then you have the profit account because that's rewarding the shareholder of the business, the owner. The next account is the salary of the owner. So you're going to next fund that account. It's another dopamine release. You're like, hey. Then you fund the tax account, which of course is not a reward. It's going to be used to pay your taxes, but does protect. So now you've rewarded. Now you protected yourself, meaning the money's been reserved for your taxes. And the last account services the business. So it has a behavioral mechanism of reward, protect, and serve. Reward, protect, and serve. And it actually starts building this profit muscle.
Okay. And guys, I know some of you are thinking, hey, I can just eliminate that tax account because we have all the incredible write-offs in the real estate business. And I'm going to tell you that would be a mistake. Yes, we have cost segregation and all these things, and many of us don't pay taxes, but I would still fill that account. And if you don't need it at the end of the year, that's just gravy that you can roll into profit. But I would still fund that account. Okay, so is that phase 2 then?
Yeah, that's phase 2. And it throws us right into phase 3.
Okay.
Phase 3 is to address temptation. And here's what I mean by temptation. Temptation, often we try to use willpower to prevent that, to use something that we shouldn't use. So like I'm trying to be on a special diet because I'm preparing for an athletic event. And my coach said, no bad carbs. That's why I just finished a banana right now for lunch. Right?
Got no bad veggie shake right here. I'm on the same.
That's freaking beautiful. So he said, no cookies. And I love cookies. So I said, well, what do I do? He said, well, there's a real simple solution. Have no cookies in the house. Because when it's not accessible, you won't consume it.
Right.
That's what we need to do with this cash. As we allocate money toward profit, that's a reserve for distribution in the future, usually every 90 days. So we allocate money toward owner's comp, that's regular salary, so I don't have to worry about that. But the profit starts accumulating, and also the taxes, because that's going to be reserved to pay our tax bill when and if they should come, and if not, it's gravy. We need to prevent ourselves from borrowing from those accounts. It's very easy to say, well, there's all that money sitting there, let me just use that, and then we unwind the system.
Right.
So the next step is to actually find another bank or some way of hiding that money from yourself. It's another mechanism called hold accounts where you can use this, do this. But basically, you transfer the profit out of sight, out of mind to another bank, no ATM card, no starter checks, no online banking. And now when the money is very hard to get, and my money is literally at a second bank, I have to drive 3 hours to get there. It's a small local bank, and I have to get a banker's check. It's a pain in the butt to get, so I don't steal from myself. So you want to remove the temptation for the profit account and remove the temptation to steal from the tax account and let that money pile up out of sight, out of mind.
Yeah, and I know some of you analytical guys are going, well, I mean, that just seems like, mental, I don't know what the acronym. Yeah. But
Voodoo.
That's really what it takes to be disciplined. I mean, I can totally relate to, having money in a separate account and then like, crap, I've got to go use it. And if it's difficult to get to, I can totally see the benefit of that. So that's phase 3, is to make it difficult to steal back from yourself, or quote unquote, I saw you do the quote marks, borrow it back because it's not going to get repaid.
And it's funny you saw it because we use soft terms like that. We would never say steal from ourselves.
Right.
We would never say I'm destroying the system. We say, oh, I'm leveraging, I'm borrowing. Those are all soft terms for stealing from ourselves.
Right. People say I'm stressed. They're just fearful. Same thing. We use these softeners to so we don't get disgusted. So what's phase 4?
Phase 4, the final phase is to get into a rhythm. And the rhythm, going back to the diet industry, they found that most people eat 3 meals a day, but we go into this peak hunger state. If we only eat 3 meals a day, there's a certain point like, I'm starving. I can't wait till lunch is served. And then we overeat. We go into a gluttonous state. So what we need to do is, they said the optimal meal frequency is actually 5 meals a day. Have actually a shake like you're doing. It's the perfect meal frequency. Right. And what happens is you get a continuous stream of nutrients, but also it mitigates that peak hunger state because you're always satiated. You're always fed. Well, in business, most businesses, particularly in the real estate industry, as far as I understand, we go into this peak state where you had some big transactions, tons of money flowed in. And we're like, we're we are on top of the
Sell
world.
an asset and have a bunch of money come in, you bet.
You think you've nailed it. And then whoosh, we go into the gluttonous state where we spend all that money and now we have nothing and panic ensues and we're starving for money. So it's very volatile and we react reactionary. And that's dangerous. So we need to have some way of mitigating this. And one strategy specifically to real estate is to set up what's called a drip. And a drip is as money flows into the income account, that money has a responsibility not just for the moment, but to cover us for a certain period of time. You know, if you're doing big transactions, let me just say once every 6 months for easy number's sake, and say a big chunk of money comes in, well, that money needs to be carved out 6 times, 1 per month, 6 slices, so it drips back into the business and normalizes the flow of cash. So if $60,000 of cash comes in, not instead of saying, hey, I made $60,000, we put into this account called drip, and every month we take 1/10 of that, 1/6 of that, so 10,000 every month goes into the income account so it can cover us for that period of time. That's how we get into that kind of regular diet and stay satiated.
Got it. So, you know, again, because I'm not an expert at this yet, I was struggling to come up when I'm preparing for this meeting with additional questions. Can you, what else, haven't we covered in this process that might pop up for people or that might be, a way to push them over the edge to implement this system?
Yeah. So one common question or one common need, I should say, is accountability. So I'll share a little story around how important this is and a little context. So I've been doing this for myself now for 12 years. I've been doing it the right way for 11 years. So I've had 43 consecutive quarters of profit distributions. Nice. And as I'm approaching my 11th year. But the first year was a train wreck. Here's what happened. Money came in, I put money toward profit, and then panic ensued. I borrowed from the profit account, stole from myself, and unwound the system. And it really became a shell game. And this is not a shell, profit is not a shell game. It is a behavioral system. It captures our normal behavior and channels it to the outcome we want. Well, what I found was missing was accountability. And accountability was specifically that I teamed up with another person, another entrepreneur, and said, listen, I'm doing this profit first system. I want to make sure that I never steal my profit, that I'm always focused on that. And I said, we can talk about it, but that's really not really accountability. What actions can we put in place? And one technique, what we use, his name was Larry, we put dual signatures on my check. So when I wanted to write
in the profit account,
in the profit account,
you had to get his signature to yank money out of there. Got it.
Yeah. And honestly, Rod, he was a little bit of a dick. Like he was a pain in the ass about me taking the money out. Well, we went to Ireland, my wife and I, on our profit. Profits always used to celebrate, always used to reward shareholders. I'll talk about that in a second. But I went to Ireland and I called Larry and said, hey, Larry, I want to issue my profit check. It's distribution time. Can you sign it? He said, yeah, no problem. Calm down. I went down there. Now, listen, I've been doing this for now, 8 years or 9 years in. And he goes, you're not going to reinvest that in the business, which is a soft term for making an expense. I'm like, no. He's like, okay. He goes, show me your reservations and bookings. Like he made me go through all these machinations. And after he saw everything, he's like, that sounds amazing. And he signed the check and gave it to me. That's the accountability that we need to have.
Yeah.
We can lie to ourselves pretty easily and manipulate and justify. But when someone else is the signator, and of course, I was a signature on his checks. So he had the same degree of accountability. And the more strict he was with me, the more strict I'm going to be with him. It's kind of like workout partners. Like when your partner's pushing you, like you're going to be pushing him. So that was very successful.
Yeah. So guys, those of you listening, what's so exciting about this is and me personally, for 40 freaking years, I've been doing it backwards. And what this does, when you take that profit first and you pay yourself first, then you're forced to make adjustments and improvements by necessity to make sure that you ensure that you continually able to take profit. We're not in this business for, unless you're doing it as a nonprofit, altruistically, we're not in this business as nonprofits. We're here to make money.
Yes.
And this is and guys, those of you are thinking how, this may not seem that important to you. Trust me, having built 24 businesses, this is freaking critical. And that's why I wanted to get Mike on the show. Get his book, Get Profit First. I'm sure his Fix This Next book is also awesome. I mean, his books have been translated into 20 languages, so he's doing something right. So, you guys know I rarely endorse anything. So definitely want to get profit first. And Mike, thanks so much for being on the show, brother. I really appreciate your energy and your wisdom.
It was a joy being with you, brother. I appreciate it.
Thank you, man. Take care.
Take care.